Hi, everyone. This is Jason Barrack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. We had him on back in October. I'm excited to have him back on. He is Dr. Marc Faber of the Gloom Boom Doom report, and he also manages money, and he's an executive at Scott. So thank you for coming back on, Marc.
It's my pleasure. Thank you.
I want to start off the podcast talking about your background. Now, a lot of people know you for being a gold investor, but you have made money in other sectors as well, such as real estate and agriculture and also the junk bond market. So could you tell our audience more about your investment background so they can know you better?
Basically, I studied in Switzerland and in London, and I grew up in Switzerland. I was born in 1946. And then in 1970, after I had my PhD, I joined an American investment bank called White Weld in New York, and I worked for them on research. And then in 73, White Weld sent me to Asia to develop their business in Asia, mostly in Japan and Hong Kong. But I also developed business in the Philippines, Indonesia, Malaysia, Singapore, Taiwan, Korea, and so forth. And what I did is advise high net worth individuals and institutions about their investments, at the time mostly in the U.S., because at the time the order flow was Asia to the U.S. And then in the mid-80s, I began to invest in Asia. I had personally already invested in the late 70s in Asia, and then White Weld had been acquired in 78. So after 78, I opened the offices for Drexel Burnham Lambert in Hong Kong and in Singapore, and I continued to advise high net worth individuals and institutions about their investments. But then more and more about global investments, not just the U.S. And by then, I had also learned about commodities, because at White Weld, we didn't trade commodities, but Drexel Burnham was very active in the commodities business, and of course also in high-yield bonds and in equities. And then in 1990, I started my own firm, which acted as an investment advisor, broker-dealer. So
yes,
this is basically my background.
Yeah, and you have extensive experience, Marc, and like Mo said, you've made money in many different types of markets. You're around for the 1987 stock market crash, which is the interview you've been giving. You're comparing what's going on right now to perhaps maybe 1987, which at the time had the largest drop in one single day on the markets.
Correct. I've made money in different asset classes, real estate, direct investments, equities, bonds, and commodities. But I also lost money in different asset classes. We have to see very clearly that where you make a lot of money, you also can lose a lot of money.
Now, I want to ask you about China. We recently had on Jim Rickards for a podcast, and he expects China to muddle through its shadow banking and credit problems by bailing out its over-leveraged banks and municipalities. Do you also expect this, or do you think China has much worse problems ahead?
Well, basically, China had a total credit of $1 trillion in year 2000. We're now at 25 trillion. Wow. So we had a huge credit expansion. I'm not saying it's all bad, but a lot of it is bad. And we have this shadow banking where rules are very opaque. And I would say it would be most surprising if they can just muddle through and not have some kind of a financial crisis at some point.
And that's a great point. And a lot of people for the past few years, a lot of experts are predicting that China real estate will eventually crash like it has in the U.S. But there's a lot of difference between the real estate here in the United States and the one in China. The Chinese use a lot of cash to buy their investment and real estate. Unlike here in America, where a lot of Americans are over leveraged and they put no money down, and they get the ARM mortgage, and also the mortgage are and mortgage-backed securities, and et cetera, et cetera. Do you see a difference in the real estate market here in China, or do you think the Chinese real estate market is heading the same path as the United States back in 2008?
What I'd like to say is that when people talk about buyers in China, also in Vietnam, acquiring properties for cash, they should ask also, where does the cash come from? The cash may have come from a lender or from family members that lend money to one member, and so forth and so on. So it's not so crystal clear that all the transactions are for cash. And the fact is that lots of companies are borrowing at very high interest rates. If everything was so hunky-dory, why would they pay such high interest rates? They're paying very high interest rates because they don't have access to credit. Credit has become relatively tight.
Now, Mark, I have an interest rate.
It's very simple. You can be in the biggest bubble, and you can find thousands of experts who will deny that there is a bubble.
But their paychecks depend on that, right? They're getting big fat commissions off selling these things because a lot of people have moved into either real estate in China or in the U.S. A decade ago, it was technology stocks. Everyone was trying to peddle technology stocks. The investment banks were all trying to, IPO these things and get their options and then dump them on the public, right?
Yes, correct. And by the way, real estate prices have recently in many cities eased and come off. It's not made public so much, but basically the demand has been slowing down. But anyway, this discussion about China being a bubble or not, all I can say is the credit expansion as a percent of GDP, which has been 50% between 2008 today, is unprecedented in any country in modern history. So you may say, oh, China has no bubble. Then I say, yeah, maybe you're right. But the credit expansion points towards a credit bubble of huge dimensions.
Yeah, and really since like 2010, China and Japan have printed a lot more money than even the U.S. has, and that's despite the quantitative easing programs. And in the U.S., in China's case, 203 programs China had to print too to soak up all of those dollars in their local economy.
Yes, and also their fiscal deficit was larger than the U.S. Relative to the economy.
Now, Mark, you talked a little bit about interest rates there. What type of long-term ramifications is the U.S. and other developed world countries facing because central banks have decided?
Hello?
I think we lost Jason there for a second, but I'll take over. Jason, you there?
Can you hear me?
I'm here.
Right. Repeat your question because you got cut off.
Okay. What type of long-term ramifications is the U.S. and other developed world countries facing because central banks have decided to?
I think we lost Jason, but I'll take over. So we're talking about the U.S. economy, and a lot of comparison between 2014 and the economy 2008 before it crashed. If you look at the stock market, there was an article on Zero Hedge that said that the stock market is as overvalued as it is in 2008 with a forward PE ratio of 15. Do you see a parallel between 2008 and now?
no bubble is exactly the same. In 2000, we had a huge Nasdaq bubble. Internet stocks, telecommunication companies, media companies, and so forth, they went to very high valuations, and the Nasdaq was selling at 70 times earnings. In 2007, at the peak of the market, it was largely a financial asset bubble and real estate bubble. And the financial sector, as a percent of market capitalization, was at the highest level it's ever been. And the earnings of the S&P were maybe 40%, 45% financial related. So we had a very specific bubble at the time. Today, we have still a credit bubble, and we have a bubble in social media stocks, biotechnology, internet-related companies, and so forth and so on. So not every company is grossly overvalued, but we have a bubble in government spending. We have a bubble relative to the real economic activity. In other words, stocks are in the sky. The Dow Jones hit a new high just a few days ago. There were only 101 stocks making 12-month highs. So it's been very narrow. But the economy, for most people, is actually still very poor.
And you had yeah. Well,
I really can't hear your questions.
I think Jason's having an audio problem, but I will keep going until Jason can fix his audio. So you're making a good point that no bubble and any economy are the same, especially the one we have now, because back before 2008, the Federal Reserve didn't have over $4 billion on their balance sheet. They were printing money, but not at the rate they are going now today. And speaking of the Federal Reserve, at every month they give out their guidance and forecast for the economy, and for 95% of the time they have been wrong with their forecast. Why do you think that is? Are they looking at the wrong type of data, or are they interpreting their data wrong because the Federal Reserve is full of Keynesian economics?
Well, I think it is very difficult to make a forecast about anything. And I can give you examples of very intelligent people having been totally wrong about forecasts. Whether it's Ken Olsen of digital equipment or Tom Watson at IBM or whoever it is, it's very difficult to make forecasts because we are dealing with the future and nobody knows precisely how the future will look like. And I think it's important as an investor to look at the mirror every morning and say to yourself, I don't know. Once you decide that you don't know, you can then diversify your assets in such a way that different scenarios will not bankrupt you. The people that make the greatest error are the arrogant people who claim they know. And I am sorry to say, because the Fed members, since none of them ever worked in his life in the private sector, they think they know because they're professors. They studied at Yale and Harvard and Princeton and MIT and so forth. But the fact is, they are the ones that are the least well equipped to make any forecasts. Plus, the statistics are grossly distorted. Nobody believes in the BLS, the Bureau of Labor Statistics. Look, today, they report on the surface good employment numbers. What happens upon publication, the bond market dips a bit, and now the bond market is up strongly. It's very interesting From the beginning of the year up to today, stocks are basically flat, despite the fact that so many people have said, oh, the market will go up, and others have said the market will go down. And for the last 5 months, people have been talking the market every day, and yet it is flat. But the long bonds, the treasury bonds, they're up 10% since the beginning of the year.
And they're using all these financial modeling to try to forecast the economy, but the economy is so complex and a lot of moving parts going around. It's hard to make a prediction and forecast in the short term. So I think that's why they're always wrong on their guidance, forward guidance each month, because they think they can zero down and correctly predict the economy. And because they...
The Fed...
Go ahead.
The Fed never thought that the Nasdaq would decline by 70% from March 2000 to October 2002. And then in 2007, most of the Fed members, actually all of them, they believe there is no housing bubble. The Fed members are for entertainment, not for forecasting.
Well, they entertain me a lot every month when they come out and do the press conference after their monthly meeting.
Yes. It's a waste of time to listen to them.
Yeah, I agree. So moving on, I want to talk about Belgium. I don't know if you heard, but Belgium has been buying a lot of U.S. Treasury lately. Where do you think they're getting the money from? Because they have a trade deficit and a budget deficit.
Well, they may get the money from another country, from a sovereign fund, or they may get the money from a buyer that doesn't want to identify or make public his identity. I don't know where the money comes from, but it's unlikely that it comes from Belgium. It may come from the ECB.
And that's a good point. Jason, are you back in the podcast, or you still having audio problems?
Can you hear me?
I can hear you.
Okay, yeah. So it's just amazing to me because I know the ECB has emergency currency swap lines where people can draw them on, but Belgium obviously doesn't have the resources to be able to buy, the majority of its GDP in treasuries. They don't. They don't have the foreign exchange reserves. They don't have the trade surplus. So it's just perplexing where they're getting the money from if they're drawing, the emergency currency swap lines from the Fed, or if the Fed just printed the money and handed it to Belgium so they could buy it, because obviously, Russia has stopped buying treasuries. It's to the stuff that's going on in Ukraine, and they have to find a buyer immediately. They have to...
Yes, this is what we just discussed.
Okay, great. So moving on, if you may or may not heard, Morgan Stanley CEO James Gorman said that the 0% of another financial crisis. What do you think of his comments?
Well, there will always be financial crisis. William White, who used to be at the BIS and in 2006 and 2007 actually warned about the global system being over-leveraged and vulnerable to a crisis. He recently published statistics that show that global debt as a percent of global GDP is now 30% higher than it was in 2007. So I have no doubt we will have another crisis. The question is it tomorrow, or is it in 5 years' time, or even 10 years' time? Because if you print money, you can postpone problems for a while. Now, as it happens, I believe that they printed so much money already that when the next crisis would about to appear, they would have to massively increase their money printing operations, which would then possibly lead to a bond market collapse and to higher inflation rates. So I don't think it will take another 5 years. Moreover, I'd just like to mention, in 1 month's time, the economic expansion in the U.S. will be 5 years old. The bull market is now already 5 years and 2 months old. In other words, we're very long. We're far above the average expansion. We're far above the average bull market. And bull markets that have lasted this long usually ended with a very significant decline. So maybe we climb to a higher diving board. Everybody says we're going to go up this year until, I think, June or whatever it is. I'm not so sure about this. I don't think the market is acting very well. Number two, we are in midterm election years. Midterm election years have a drawdown, usually of at least 10%. In 17 of the last 21 mid-election years, the market dropped between high and low by at least 10%. The average decline was 19%. So, all I'm saying is, I don't think it's a very good time to buy U.S. stocks.
And I agree there. It's a very dangerous time to buy U.S. stocks. A lot of experts, including yourself, are predicting a correction in the market, a correction or a crash. And a lot of that is due to, because the stock market has been going up and up ever since March of 2009. There got to be a time where the market has to draw back and correct itself and clean out the system.
We had a correction in 2011 when the market dropped between, I think, August and October 2011. It dropped at the time, if I recall, by 21%. And after that, we haven't had a more than 10% correction.
Right, and I that's a good point there. I forgot about the 2011 correction. So we took a question from our listeners that listen to our podcast, and if you don't mind, we're going to ask you one of their questions that they sent to us. And
yes.
One of them was one of our YouTube followers, and his question is, what did you learn from shorting technology stock too early during the tech bubble in 1999 and 2000?
Well, a bubble is a bubble, and a bubble, the sectors can be overvalued and become more overvalued. It's like Japan. In 88, it was overvalued, but it still climbed until December 89, and then it dropped 70%. So when you see a bubble, I'm not necessarily suggesting that the individual investor should short stocks, because people feel very uncomfortable with being short stocks. But if he knows that it's a bubble, he should know that the risk-reward is not particularly favorable. In other words, if he buys a stock, he would have to put a stop-loss order. And just to remind you, since the end of last year or February of this year, many momentum stocks, whether it's Netflix, Facebook, or LinkedIn, and Twitter, and so forth, they are down between 30 and 50%. 3D systems, all these stocks are down already 30 to 50%. Facebook is only down 20. But I'm saying the bubble sectors, you never know exactly on which day they will peak out. And I would be very careful as an individual investor and non-professional to short these names.
And that's a great point. And it's hard to time the market exactly. As you said earlier in the podcast, you can make a lot of money and you can also lose a lot of money. That even a great investor out there like you had, was off on timing.
For me to make a difference,
Right.
I would have to short something like $50 million worth of shares. Do I want to take that risk? If the market if they move against me, we live in volatile times for these high flyers. They can move 10% in one day. So in theory, I could lose on $50 million, $5 million in one day. I don't want to take that risk. I'm too old.
Yeah, it doesn't make any sense to risk $50 million, especially a person like you, already accomplished and already successful. No need to take that risk in the market when it's, heavily manipulated by the Federal Reserve and other central banks.
That's the problem. We don't know how far their manipulation will go on. And you see, in Japan, people have been shorting JGBs for the last 10 years. And because of the government's manipulating interest rates, the JGB 10 years yield is still 0.6%. I mean, one day it will blow up. One day these yields will go to, say, 2-3%. But it hasn't happened yet. It's like the 10 years yield in the U.S. I bought some 10 years notes last fall when the yield approached 3%. I don't think it's a good investment. The maximum you can earn on a 10 years note over 10 years at that time was 3%. Today, the yield is 2.58%. So the maximum you can earn over the next 10 years if you buy a treasury note is 2.58%. I don't think it's attractive, but I look at treasury notes and treasury bonds as kind of an indicator and also as a hedge against the stock market. If there's a stock market collapse, the money will flow into what people, I'm not saying it is, but what people perceive to be a safe asset. And they'll go and chase and buy these treasuries. By the way, I find it very extraordinary with all the talks about the U.S. economic recovery that since the beginning of the year, treasury notes and treasury bonds have rallied.
And yeah, you're right. The treasury bond is perceived to be safe haven for many of the investors out there. But what about gold? Do you think people would go into the gold market as well?
Well, the gold market, as you know, had a huge move between the end of the 1990s, 1999 specifically, $252 to $1,921 in September 2011. And now we've been in a correction period. I happen to think that the correction has run its course and that probably some money should be allocated to gold. But I don't advise anyone to put all his money into gold. I know some people who are very intelligent who have most of their money in gold, if not all. And gold shares, gold physical form, gold shares, platinum, silver, and so forth. But I advise individuals, and each individual has a different financial position. That's why, for me, I cannot give advice to each person. It's like a doctor. He cannot advise everybody at the same time. He can give guidelines. So my guideline is to have about 20-25% of your money in physical gold.
And it's good to be diverse in your portfolio. You never want to have too much of one thing, especially a commodity market, because it's very volatile. And in 2013 was a bad year for commodities.
In addition to that, investors must realize, say, if I buy a 10 years note, and I really hate myself for owning these treasury notes, but basically after a year, I have a 3% cash flow. Also, if I own some Asian REITs, REITs, I have, say, a 5% dividend yield. So after 1 year, if the asset has gone down in price, I have at least 5% to invest at a lower price. With gold, I don't get any dividend at all. So, to have all your money in gold, and then the price drops, you don't have reserves to add to your position.
But if people want to buy gold stocks that pay dividends, that would be a good alternative, don't you think, or no?
Yes, the gold shares were very, very inexpensive last October, November. And since then, they rallied roughly 50% from the lows until about February, and then they corrected 25%. But we're still up from the lows, sometimes in October, November, by 25%.
And that's a great point. Now, Dr. Marc Faber, we appreciate your time for giving us for doing a podcast with us. If people want to find more about what you do, where can they go?
They can go to my website, www.gloomboomdoom.com.
Okay, great. Well, thank you for coming on, and hopefully you can come back on again.
Yes, sure. Thank you for having me. Thank you, and I wish your listeners a nice weekend.